I'm going to be completely honest and say this. Housing in Australia is becoming very unaffordable. If you live in Melbourne and Sydney like I do, then you will know exactly what I'm talking about. I am 28 years old now and my income puts me in the top 1% of income earners for my age. Yet I find the properties in my hometown of Melbourne extremely expensive. Even for a mid-tier suburb like Footscray, Springvale or Coburg, the price for a freestanding house is well above $1 million. And if I want to buy into a blue chip suburb like Balwyn or Brighton, I will need to spend at least $2 or $3 million. And even after I put down a 20% deposit, my monthly repayments will be more than $10,000. And the sad truth is that everyday Aussies that are on ordinary incomes are getting pushed out of the good suburbs. And they are now moving further and further away from the desirable locations. And with this property boom taking property prices to new heights month after month, it seems like that even the city's fringe is now becoming unaffordable to many Australians. You guys know that I love statistics, so here are some for you. The Australian government expects to achieve a wage growth of 3% by 2023. That sounds amazing, doesn't it? Except for the fact that our national house values grew by more than that over the last 2 months. In fact, as you can see in this graph provided by CoreLogic, in some of our markets, we have seen a growth exceeding 20% over the last 12 months. To put it simply, house prices are growing 10 times faster than wages. If this trend continues, housing in Australia will become very unaffordable, even to the high income earners. So in today's video, we are going to talk about the great Australian dream and how we are now on track to become a nation full of lifelong renters, as well as how we can protect ourselves from becoming a lifelong renter. Hey guys, welcome back to the channel. My name is Zeng and I make weekly videos on the topics of personal finance, property and real estate investing. So if you want to make sense of this crazy market that we find ourselves in, make sure to subscribe to the channel and smash that like button right there to support the channel. As always, this is not financial advice and I am not a financial advisor. I am simply sharing with you my personal opinions and strategies, and I will always recommend you to do your own research and due diligence and seek the help of real financial experts. And without further ado, let's get straight into the video. Let's talk about the Australian dream. When our parents and our grandparents were growing up, working hard, saving enough money and buying a house was a rite of passage. And this was usually done on a single income. Fast forward to now, we are now in a completely different world. And it seems like the great Australian dream is becoming more and more out of reach. If you're on a regular income and you live in Melbourne or Sydney, then you will quickly realize that there's not much in your price range. And if you want to stay close to the city and close to work, then renting might be your only option. This trend of decreasing home ownership in Australia is gaining momentum. And it doesn't seem like this trend is going to reverse anytime soon, with the government and the Reserve Bank of Australia doing everything they can to keep the property markets pumping. According to the Australian Institute of Health and Welfare, home ownership numbers are dropping rapidly across our entire population. The decrease is more noticeable in the 25 to 29 age group, as well as the 30 to 34 age group. For Australians aged between 30 to 34, only 50% were homeowners back in 2016. That's down from the 64% recorded in 1971. For Australians aged between 25 to 29, only 37% were homeowners back in 2016. That's down from the 50% recorded in 1971. Furthermore, the data in the next graph that I'm about to show you shows just how bad the problem is becoming, and the concerning trend that suggests we could soon become a nation full of renters. Let's start with the blue line, which shows the percentage of homeowners who do not have a mortgage. And as we can see, that has been decreasing rapidly over the last 20 years. On the other hand, the green line, which shows the percentage of homeowners who have a mortgage, increased rapidly from 1994 to 2004. But that trend has since slowed down and has started trending downwards over the last few years. Now, this black line is the one that concerns me the most. This line represents the percentage of renters who rent from private landlords. As we can see, this has been a steady upward trend and it does not seem it is slowing down at all. Let's now put all of this information together and try to understand what is happening. If you want a simple explanation for what is happening, we can just look at this graph here that shows the property prices in Australia over the last 25 years. As we can see, this is where the problem lies. House prices in Australia have gone absolutely crazy. This is pricing people out of home ownership, and those who are getting into the market are taking on huge mortgages to do so. It is hard to predict the future, but based on what is happening right now and what we are seeing in the data, I personally expect the number of homeowners to continue to decrease, and the number of renters will continue to increase over the coming years. Look, this is only my personal opinion, and I don't expect everybody to agree with me. But let me show you what some of the smart money in Australia and the biggest investment firms are now doing. Macquarie Asset Management, one of Australia's biggest investment firms, have just raised $1.1 billion to invest into real estate. According to this article by the Financial Review, the investment giant raised $1.1 billion of equity from institutional investors for its new partnership, which has a mandate to invest in opportunistic real estate across the Asia-Pacific region, including Australia. Reading further into the article states the majority of our investment focus will be on the rental, housing and logistics, or beds and sheds. Mr. Robson told the Australian Financial Review you will be less inclined to invest in office or retail assets. By beds, Mr. Robinson is referring to the whole rental sector, including student accommodation, built to rent, seniors housing, and manufactured homes, he said. Now, let's digest all of this information and figure out why one of Australia's biggest investment firms is now taking up an interest in built to rent. Traditionally, developers in Australia have followed a model that is known as built to sell, which simply means the developers will try to build as many apartment complexes or townhouses or new estates as possible and sell those upon completion or off the plan. However, from the information provided by this article, it seems like the developments in Macquarie's portfolio will now focus on building these properties, holding onto them, and then leasing them out to tenants. In my personal opinion, there are a few reasons why they have shifted their business model from building something just to sell it for profit and to now building it and then leasing it out. The first and most important reason is the unaffordability of our most expensive housing markets like Melbourne and Sydney. As house prices continue to grow at a rate that is much faster than wages, more and more people will be forced into renting. And if we now look towards the housing markets of the other countries such as Hong Kong, England, France, and Canada, where housing in some of these bigger cities are so unaffordable that people have no choice but to become lifelong renters. Macquarie Asset Management and the other build-to-rent companies in Australia have obviously noticed this trend, and they are now establishing themselves in the market to take full advantage of this growing trend. These companies make themselves stand out compared to traditional landlords by making a rental property feel more like a home. By allowing the tenants to have pets, by allowing the tenants to choose their own wall colors, to choose the length of their lease, giving them more flexibility, at the same time security. This is the sad truth behind growing property prices. And if property prices continue to outgrow wages in the coming years, this is the path that we are heading towards. Look, I don't know about you, but I personally have no intentions of becoming a lifelong renter. And my assumption is that you don't want to either. But with housing becoming so expensive and unaffordable, how can we protect ourselves? Let me just clarify that I am not a financial advisor, but I'm always happy to share my personal opinions and strategies with you guys. So here are some of the different steps that I'm taking to protect myself. I'm sure some of you guys have heard of this story already, but when I first got into real estate, my family and the people around me were very biased towards Melbourne and Sydney. And they said that I'll be mad to buy a property in any other markets. Looking back now, I am so glad that I did my own research and I was open to the idea of purchasing a property in a different market, because my interstate portfolio has performed extremely well over the last few years, strongly outperforming Melbourne. We're talking about a growth that is 2 or 3 times higher than what we have seen in Melbourne over the last few years. If you're too fixated on a singular market, then you are limiting your options and your opportunities. Instead of saving your ass off to try get a deposit together for $800 or $1 million house in Melbourne or Sydney, you could get into a property much sooner in the other states. In my personal opinion, owning an investment property interstate is better than not owning any properties at all. At least the strong rental income from that investment property can help you pay the rent here in Melbourne or Sydney. The next option is definitely a bit more risky, but it can definitely help you get into the market a lot sooner. And that is to pay the lender's mortgage insurance and purchase a property with a small deposit, for example 10 or 15%. I will make another video going into more detail about lender's mortgage insurance, interest-only loans, and some of the other creative ways that you can use to get into the property market sooner. If that's something you're interested in, make sure to subscribe to the channel. Now, even though using lender's mortgage insurance is a bit more risky, it could be your only option if you're struggling to save a 20% deposit in this crazy housing market. A lot of my viewers are telling me that despite saving more and more money every single month, they feel further and further behind because the property market is going at such a rapid rate. If you're 100% certain that you can service the mortgage even when we see higher interest rates, then using lender's mortgage insurance is definitely a viable option. These are just some of the different ways that you can get into the property market sooner and become a homeowner. But make sure to do your own research and due diligence before implementing any of these strategies. Alright guys, thank you for watching the video to the very end. Let me know in the comment section below, do you think we are becoming a nation full of lifelong renters? Stay safe out there, and I'll see all of you guys in the next video.